Good morning, folks, and welcome to this morning's video. I hope that you had a great weekend. I have four pairs on watch today, and those are Sugar USD, Pound Kiwi, Dollar CAD, and Pound Aussie. So my favourite of the bunch, I've just juggled these around a bit, juggled them around, swapped in a pair here and there, and reordered them a little bit. But I don't know what's happened here. But this is my favourite of the bunch, Sugar USD. So quite simply, this is quite a straightforward one, really. We have this move down here, okay? We have the impulse down, and then we have a correction, and then we have a little bit of a sharp move there, and then a sell-off, okay? Price gravitates all the way back up to this area in a corrective way, okay? That in itself implies a further move to the downside, and then we get this last little bit of momentum here, which is what we typically see if an area such as this is actually an area of value. Okay, so we'll typically see a corrective move up to it, and then the last little push will have momentum as the buyers get out of their positions. Okay, and what we usually see on these higher time frames or with these higher time frame liquidity points is we usually break above, catch people the wrong side of the market who think it's going to the moon, and in this case, most likely because some people would have seen, this acting as support now. Okay, both this and this acting as support, so they get long and then they get completely washed out. Okay, and one of the clues for me was this scoop here. Okay, when we get a big scoop like that, that's often a clue that we're moving to the downside. Okay, and the other one is that we'd come from an impulse. Okay, and we'd broken below here and corrected. Okay, and we had further downside, suggesting that price did not find enough liquidity at this low to move it to the upside, implying that this is just people getting caught the wrong side of this high. If we'd have just tapped below and tapped back up, that may have been a different story. Okay, just analysing some of these things. These are the kind of thoughts that go through my mind when I'm breaking down these pairs. So on the weekly, you can see that we've had that evening star formation move up, the star, and then the follow through on the weekly. That's what I like. One of the things I like about this heavy bodied weekly candle, which closes back below here, and back within this structure. Okay, below this high and above here. Okay, and we have a bit of a wick above it, suggesting that liquidity was grabbed and that will likely follow through all the way down to there. Hence why my target is there. Okay, so as we zoom in, you can see that we have the wick to that candle is there, which just happens to be the retest to the back end of that. So if we zoom down, you can see what happened. Price wicked to this high and narrowly missed it. Okay, it also narrowly missed the retest to the back end of that, implying that we'll likely come back up. Okay, and that to me just looks like it's quite a simple one, really. This to me looks like if we just get the forecast in the chart, this looks like the beginning of a potential three-touch structure. Okay, normally when we get a bit of a sharp move up, so if this wasn't here and we just had this sharp move up, I would think that something like this would be more likely, the three-touch structural approach. But what I've seen in my trading is when we kind of get this 1, 2, 3, when it starts off like that with a bit of a 1, 2, 3, these tend to more often than not turn into three-touch structures. Okay, rather as opposed to a two-touch structure with a three-touch structural approach, which I drew. But either or, if any of those shape up on the 1 hour chart, of course, this might not be ready by the end of the day simply because it's sugar and sugar's opening hours are a little bit less than Forex. But if we get that, we get the three-touch 1 hour continuation or the two-touch 1 hour continuation with a three-touch structural approach, then I would look to get short with a risk entry from the top of the structure. I would have my stop loss protected above here and above the back end of that as well. Okay, so it'd be above that as well. And then we would likely, the first target would be there, okay, because that high is already above that, so that's not relevant anymore. The first inflection point, if you would be there, and my target would be, what I would do is, as usual, as you've often seen me do, I would use the mechanical management tool, and I would measure it from there to there, the 90% area is typically where we pull back deeply, even if we are going to continue in the forecasted direction, and that would give us something in the region of 9%. Does that make contextual sense? Well, if we measure this impulse, okay, and we assume that the leg out is of a similar length, and we measure it from the break, because the volume that's been generated within here can dictate how far we go. That lines up with that area as well, so that makes contextual sense. So alert set there to see if we push up to that area. If we don't, no trade for me. Okay, so that is sugar USD. So pound Swiss is one of the ones that I literally just put on. This was in my additional pairs on my two main watch lists for the week ahead, but I've just moved this on. Was it this one? Yeah, I think it was, yeah, because it got there slightly quicker than I was anticipating. So on the higher time frames, we have this. Now, we do have to be mindful of the fact that if we just look at this move down, okay, actually, let's get the fib tool. So we have this move down there, okay. So we have this impulse down, which ended here, and we've already pulled back about 80% of the way. So we do have to be mindful of the fact that in such instances, we may get a move, because we've retraced so much of that move, might get a move all the way up to here. That's partly why this is slightly lower down on the list than sugar. And also, if we measure this, okay, and we assume that this is an impulse correction continuation to push higher, okay, that would take us up into that region and also up to where that sharp move is, okay? So we have that sharp move there where there was a massive sell-off to the downside, implying that there might be a lot of liquidity here. But as I often say, that doesn't mean to say that we can't capitalize on a move to the downside in the meantime, because we do have this big scoop. So even if that was to occur, what I just drew on a second ago, not there, but before that, okay, we may see a move down to here, and I shall explain why in a minute, or maybe down to these areas before we actually tap into that area, okay, to give us more of that, okay, if we're going to tap into one of these two highs here. Okay, so not everything has to happen straight away. So though you might think, well, why would you be getting short here? Because things can happen in between before those highs are taken out, if they're taken out. Okay, what we do have is we have a high here. We have an M-style pattern. What I know about M-style patterns, so when price builds up too much volume here, and it becomes more neutral, and rather than pushing to the downside, the correction becomes so wide that it becomes neutral and it pops out to the upside and taps into the high that it previously came from. Okay, and then we have that big scoop. These scoops are often an indication. These M-style patterns tend to be very aggressive when they push to the downside. Okay, so what I'm looking for in this instance, and we know, you might be thinking, well, it's broken above. As we know, these higher time frame liquidity points that stand out, the more time frames they stand out on, these tend to break above before moving to the downside. So that is why I'm looking for a short trade on this at the moment. Okay, so what I'm looking for in this instance is I'm looking for, you can see it's popped higher. I don't mind that at all. If we push down below this area of interest there and we consolidate afterwards, that implies a washout of orders from here, and that implies that, you know, this is not some kind of bull flag to push higher. If we consolidate below this low, then I'll be looking to get short on the break of either a 5-minute flag or a 15-minute flag, or I'd be looking for a risk entry within the structure if the structure was bigger than a 5-minute continuation. Okay, and I'll be able to manage it down to that first sharp move there for something in the region of nearly 3%. And then I would use the mechanical management tool again, measure it from the high that we broke above down to there. Okay, and then I would set a take profit at the 90% area whilst trailing my stop loss, and that would give us something in the region of around 6%, depending obviously on the size of the stop loss. Would I consider a long? I would consider a long if we got, okay, we have a bit of a base there. So you can see that we have a bit of a base there. We've kind of near missed to it. So if we got but bear in mind this is a daily forecast. So if we got something like this, I've got something like that. That is implying that this was not people getting caught the wrong side of the market, but actually price building volume for the next wave to the upside. I would consider something like that. It would probably need to be, for it to generate enough volume for it to be able to push up to those higher time frame liquidity points, which I showed you a second ago. It would probably need to be a larger structure than that. So it would probably look something more like, something like that. But I would consider a long if that happened, because that is the market giving us a message that this is not people getting caught the wrong side of the market, and this is actually just price building volume for the next move to the upside to complete that to take out those higher time frame highs, because of how much of this move we've actually retraced. Okay, so as I said in previous videos, I'm trying to be more neutral and flip my bias, and that's a good way of not trying to be right, which is what the amateurs are doing, and not being stuck in one way of thinking when the market has shown you a clear sign that the wind has changed direction, as it were. So what I've got is I've got an alert set just above the area of interest, and if that does not trigger, then obviously what I've forecasted today hasn't shaped up, so I don't need to check it. So dollar CAD, this is a prime example of being neutral. I don't know why that's moved, but it has. So on the daily chart, we have this impulse down followed by a correction. Normally, the natural ebb and flow and things is a continuation to the downside, especially as we have a potential wick fill here. Okay, so when we wick, when the wick is to the area but not through it, that implies that we're going to come down to fill the wick before a potential move to the upside. Okay, if there was to be a move to the upside, and the more time frames that we see a wick like that to an area of value on, the more likely that wick is to be filled. Okay, so that gives weight to the idea. You see wick to the area of value on the 1 hour, the 4 hour, and the daily, and the DXY at the minute, which is the dollar index, is positioned to potentially. You can see we've had an impulse correction continuation, and it looks like we have a further impulse correction potential continuation to take out this low, which this low near miss 2. If that was to happen, then dollar CAD would likely move in alignment with it. Okay, although dollar CAD does tend to move, have a slight mind of its own to some extent. But we also have to remember that we have actually tapped into this area. Okay, so potentially, even though we've wicked to the area, this could break out to the upside to complete an M style pattern. Okay, where we have this, which is what I just showed you a moment ago on pound Kiwi. Okay, and if we were to get a move to the upside, this would likely be aggressive because it would likely replicate the aggression with which it moved on the way down on the way up. Okay, so this is a prime example of being neutral. So you can see we've broken above the area now, but that doesn't surprise me because we can see this high on the daily chart. So the higher time frame highs are typically where we break above if we're going to move to the downside. Okay, so what I'm looking for on this pair today is two things. I'm looking for, if we just put those back in their box, so I'm looking for either a break back below the area of interest followed by a continuation, which I've described here. Okay, or I'm looking for a break, and then I would look to get short on the break or within that continuation, and I would measure the range from there to there. Actually, in this instance, I've got my target. That's probably why I got my target arrow lower than that. I don't know why it's there. It shouldn't be there. But in this instance, I would probably be targeting one of these lows because the profit potential is not as great. Yeah. So I'd be targeting, if I'm going to use the mechanical. Actually, no, that's right. Yeah, I remember what I was going to do now. So I'm going to set the take profit at the low, not at the 90% area, because my minimum profit target when I use the mechanical management is 5%. So I would actually literally just set a take profit at the 90%, at the 100% mark in this instance, and trail my stop loss, because if I was to set it at the 90% area, that would give me less than 5%, and that is 5% is my minimum. Okay, so the other alternative is that we break above this area of value, and then we get something like that, okay, above it, And then that is the market confirming, if we get a 3-touch like that or a 2-touch with a 3-touch structural approach, that price is not moving to the downside, and that just as with pound Kiwi, this is actually price building volume for the move to the upside to tap into that high, and then I would be able to manage it up to this high for something in the region of 2.5%, and then I would use the mechanical management tool and set a take profit at the 90% area there, whilst trailing my stop loss. You might be thinking, well, why haven't you got 2 forecasts on for pound Kiwi? Well, the reason I haven't got 2 forecasts on for pound Kiwi is because the structure that would likely form on that, or that I would need to see to take that, would need to be larger, and it wouldn't be ready by the end of the day. The structure could not form if you were to count the candles by the end of the day. That's why it's not currently on my chart. I try to keep as little on my charts as possible at all times. So that is dollar CAD. And so last up, I'm neutral on that one. Pound Aussie. Pound Aussie is another one which I'm potentially neutral on, but again, just as with pound Kiwi, the second forecast on this would likely not be ready by the end of the day. So we have the same thing again. We have a potential wick fill down there. Okay, market looking quite similar across the board in many respects. We have a wick fill on that area. To the low there on the 4-hour time frame as well. Same thing on the 1 hour. To me, what it looks like at this moment in time is price, because price has not responded from that area, it's disrespected that area. What it's looking like to me at this moment is we get something like that, and this is actually a move to the upside. But again, and I would consider that again, this would not be ready by the end of the day. You only have to count the candles. We're on the 1 hour chart. Okay, so the reason I've not got that on my chart at this moment in time is because it wouldn't be ready by the end of the day, and this is a daily forecast. So in terms of daily forecasts, what am I looking for? Well, what I'm looking for is so you can see we've broken above the high there. Okay, this is what I actually think is less likely, but it's what I think would be more likely by the end of the day, if that makes sense. Okay, so where does that buy idea become invalidated? Well, it becomes invalidated to me so you can see this little wick here. Okay, we have the wick there, which retested the back end of that. If we break back below that and we flag, we would not only have invalidated the buy idea, but we would also be trading back below this area of value. So with that in mind, what I'll be looking for from this pair today, of course, that might change as the week goes on. I'll be looking for a break below here. And in this instance, I'll be looking for a risk entry within. So when we're retesting the back end of something else, I always look for a 15-minute continuation, not a 5-minute, okay, just for a little bit more deliberacy to make sure that this isn't actually part of this, okay? So that's why I'm looking for a 15-minute continuation and not a 5-minute. But in this instance, I will be looking for a risk entry within the structure, and that is simply to help me manage the trade to this low, because this low here actually retested the back end of this. And if we actually measure this, I've just noticed this, if we measure the whole impulse, that is actually the 50% mark. So in theory, we could actually see, I don't think this is likely, but we could actually see a larger structure like that, which taps into that and then pushes to the upside. So by waiting for the risk entry within the structure and not taking the reduced risk entry on the break, I will be able to manage it to this low. You might think, well, you've got 1.5% there. Yep, but I've also got a very busy schedule. So I'm factoring these things in. By only taking the risk entry within the structure and not the entry on the break, I'll be able to manage it down to that low for something in the region of 3.5%. If let's try that again. If we were to tap into that, push up, and then form some kind of larger structure, which gave us that. Okay, so that is in my thinking as well. So I've got an alert set just above the area of value. If it doesn't trigger, I don't need to check this pair at all. Okay, and what I would do is I would use the mechanical management tool again, and I would measure from this range to the bottom, and then I would set a take profit at the 90% area while simultaneously trailing my stops. I hope I've explained that in enough detail. It's not easy when you've only got 20 minutes to explain 5 years worth of trading experience and the entire thought process, but that's what I'm going to be looking for. I hope you've enjoyed this video, and I will see you again in the next one, which will likely be made tomorrow and may include a trade recap if I've actually placed a trade. Enjoy the rest of your Enjoy the rest of your day, and I'll speak to you again soon.